Have you ever daydreamed about retiring early, perhaps in your 40s or 50s, and living the good life? That's the allure of financial independence, a state where your wealth works for you and you no longer need to trade time for money. Financial independence is not a pipe dream. It's an achievable goal, and the path to it is paved with knowledge and discipline. It's about understanding the power of your money and making it work for you. Our journey today will unravel different investment options that can help you reach this coveted state. From exchange-traded funds to real estate investment trusts, S&P 500 index funds to 401k and Roth IRA, and not forgetting mutual growth funds, we'll explore them all. Remember, the aim here isn't to chase trends. It's about investing wisely and consistently rather than merely saving. It's about learning techniques such as dollar cost averaging, which can help smooth out the bumps in your investment journey. Understanding various investment options might be your first step towards financial independence. So, let's embark on this journey together. Ever heard of exchange-traded funds, or as they're often called, ETFs? No? Well, you're in for a treat. ETFs are like a basket of different investments. They can contain stocks, bonds, commodities, or a mix of these, and they trade on a stock exchange, just like individual stocks. What's the beauty of ETFs, you ask? Well, they provide you with the opportunity to invest in a wide range of assets without having to buy each one individually. This means you can diversify your portfolio, spreading your risk across many investments rather than betting everything on one horse. And why are they great for beginners? Because they're easy to buy and sell, and they often come with lower costs than other investment options. Plus, they can provide exposure to different industries, regions, or investment styles, all in one neat little package. ETFs offer a simple way to diversify your investment portfolio. Now let's dive into the world of real estate investment trusts, or REITs. Imagine owning a slice of a shopping mall, a hotel, or an apartment building. That's what REITs allow you to do. They are companies that own, operate, or finance income-producing real estate. When you buy shares of a REIT, you're essentially becoming a small-scale property investor. REITs are required by law to distribute at least 90% of their taxable income to shareholders annually in the form of dividends. This means a steady income stream for you, the investor. Plus, because REITs trade on major stock exchanges, they offer the benefit of liquidity. You can buy and sell shares just like you would any other stock. For beginners, REITs can be a less intimidating way to get into real estate. They offer the potential for solid returns, diversification, and income. REITs can be a great way to invest in real estate without the need for a large capital outlay. What about S&P 500 index funds? Ever considered investing in them? They're a type of mutual fund or exchange-traded fund that mimics the performance of the Standard & Poor's 500 index. This index is a compilation of the 500 largest publicly traded companies in the U.S., and P500 index funds work by holding the same stocks as the S&P 500 index in the same proportions. So when you invest in an S&P 500 index fund, you're essentially buying a piece of the 500 biggest companies in America all at once. The benefits? Well, these funds offer diversification, which can help reduce risk. Also, they have lower fees than actively managed funds because they simply mirror the index. No need for a fund manager to research and select stocks. So if you're starting out, S&P 500 index funds can be a good choice. They offer a low-cost way to invest in a broad market index. Now, let's talk retirement plans, specifically the 401k and Roth IRA. First up, the 401k. The 401k is a retirement savings plan that's typically offered by your employer. This plan allows you to contribute a portion of your pre-tax salary, which means you're not taxed on the money you put into it until you withdraw the funds at retirement. One of the biggest benefits of a 401k is that many employers will match a portion of your contributions. This is essentially free money that can significantly boost your retirement savings. Now onto the Roth IRA. Unlike the 401k, a Roth IRA is a retirement account that you set up on your own. You contribute post-tax income to a Roth IRA, but the big advantage here is that you don't pay taxes when you withdraw the funds at retirement. So how do these two plans work? Well, the money you put into both a 401k and a Roth IRA is invested in a variety of assets like stocks and bonds. These investments have the potential to grow over time, helping you build a nest egg for your golden years. But why should beginner investors consider these options? The answer lies in their simplicity and benefits. Both the 401k and Roth IRA are designed to be easy to understand and use. They offer tax advantages that can save you a significant amount of money in the long run. Plus, they force you to save and invest for the future, which is a habit that many of us could benefit from. Keep in mind, though, that these plans come with some restrictions. For example, there are limits to how much you can contribute each year, and you may face penalties if you withdraw the money before reaching a certain age. In conclusion, if you're looking to start investing and planning for retirement, a 401k and a Roth IRA are excellent places to start. They're not just retirement plans, they're investments in your future. 401k and Roth IRA are powerful tools for retirement planning, offering tax advantages and long-term growth. Last but not least, let's discuss mutual growth funds. These funds are a type of investment vehicle where money from multiple investors is pooled together. This pool is then managed by a fund manager who invests in a variety of growth-oriented stocks. The aim is to achieve capital appreciation over the long term. The beauty of mutual growth funds lies in their diversification. Instead of putting all your eggs in one basket, your investment is spread across multiple stocks, reducing the risk of significant losses. This makes them a good option for beginner investors who may not be comfortable taking high risks. Moreover, mutual growth funds are managed by professionals. This means you don't need to be an expert in the stock market to invest. You have the benefit of their expertise and experience. In summary, mutual growth funds offer a way to invest in a broad range of stocks, managed by professionals, and are designed to grow over time. Mutual growth funds can provide a diversified and balanced portfolio for investors. We've covered a lot of ground today, haven't we? In our journey to financial independence, we've explored the realm of exchange-traded funds, or ETFs, a straightforward way to diversify your portfolio. We've delved into real estate investment trusts, a unique means to invest in properties without the hassle of actual ownership. We've also navigated the waters of S&P 500 index funds, a reliable and passive investment strategy. We've broken down the benefits of 401ks and Roth IRAs, the retirement plans that can secure your financial future. And let's not forget the mutual growth funds, a basket of stocks that can provide substantial growth over time. We've learned that investing is not about following trends, but about understanding and making informed decisions. We've seen the importance of investing over merely saving and how the strategy of dollar-cost averaging can mitigate investment risks. Remember, the journey to financial independence begins with a single step. Start investing today and your future self will thank you.